Okay, welcome out to another Platinum University quick hitter for some quick training. Today we're going to talk about FHA loans and just some basic quality things that you need to know about FHA loans. Things that obviously will pertain to any buyer or seller. If you're working with a seller, if an offer comes in on FHA, obviously that'll affect the seller as well. So, a couple things to think about. FHA is the most common loan out there, right? It appeases to the masses. It's not a first-time home buyer loan. Back 25, 30 years ago, that was deemed a first-time home buyer loan. Is not that way anymore. FHA has its own requirements. Anybody can get it. Doesn't matter how old. If you've owned homes, FHA cannot do investment properties. These are owner-occ only. Owner-occupied only loans. I think the rule is, and it changes every year, but the buyer must take possession within 90 days of closing. So if you buy a house that has a renter in it, you can still do an FHA loan. So you take occupancy within, I think it's 60 to 90 days after closing. So if a tenant's there and they hang over for a couple of weeks, you can still do an FHA loan. You can't keep that tenant in the property past that. So it's not a investment loan at all. It's owner-occupied only. And if you already have a loan, you can't have another FHA because then it would be considered an investment or second home, and FHA can be done for that. One thing to keep in mind, you have a client that lives in Idaho, and they're moving to Arizona. I think the radius is 60 miles, 65 miles. If they move more than 65 miles away from their current property because of their job or anything serious like that, sick family, something along those lines, they can get another FHA loan. So don't rule that out if somebody's coming in from out of state, but if you're in the valley and you're moving from Gilbert to Mesa, you're not going to be able to get another FHA loan. So unless you sell the other house, then you free yourself up on the FHA again. So I hope that makes sense. So there's potential to have two FHA loans, but you'd have to be, I think, 65 miles apart from each property. Now, in the valley, you could have two homes 65 miles apart. That would be a judgment call, and you can't guarantee that they'd still do that. But obviously work with your lender, and knowing that and talking to your clients is going to make you that much more dependable because you're going to show your expertise. You're like, hey, I already know this. Not a lot of agents know this, but I do. That's what makes me the best. All right, it's easiest to qualify for. DTI, debt to income ratio, with the mortgage is pretty close. Whoops. Depending on credit score and everything like that, your debt to income ratio is about 50 to 55% on the high end. So it's easiest to qualify for because the debt to income ratios are the most flexible and largest compared to other loans. So again, check with your lender because some lenders might change what that DTI needs to be on the back end. The back end number is the number including the mortgage. The front end number is the number not including your mortgage. So your credit card debt, your card payment, those kinds of things are in your front end number, and then they add in the mortgage amount into your back end number. So front ends, back ends, and the DTI are good to know, especially when you're working with a lender and you're working with an FHA buyer. You need to kind of know those things. And there's another reason why you're going to want to know that in the future. Down payment's only 3.5% of sales price, right? So if you have a $200,000 loan, 3.5%, $7,000. That's their down payment. Now that doesn't include closing costs. So keep that in mind. The other thing to keep in mind is if you have them put earnest money down, which most transactions we do, let's say the earnest money is $1,000, make sure on that line in the contract you put applied towards buyer's down payment. Tell title what you want to do with that $1,000. Now when they go to close, they only owe $6,000. So not $7,000. If you put $1,000 towards the sales price, then they still need $7,000 when they close. So specify earnest money is applied towards your buyer's down payment. And that way their $7,000 down payment, $1,000 earnest money comes off that $7,000 and they only need $6,000 to close. Again, doesn't include closing costs, which we always preach. Try to get those closing costs covered by the seller. So you can also do gift down payment. Employer, depends on the lender, but family. Here's the trick. If your brother gives you $7,000 cash and you put it in your bank account, it's not going to fly. The bank needs to see where the money came from, into your account, when, and what the amount was. So if you said, hey, my brother sent me $7,000, they're going to say, okay, show me your bank statement that shows the $7,000 coming in, and then we want to see his bank statement showing the $7,000 coming out. Right? So you can't do a back alley deal and take $7,000 cash, put it in your account. They're going to want to know where that $7,000 cash came from. So you have to make sure you educate your buyers because if they screw this up, it's a nightmare on the lender side. Don't assume the lender's going to instruct your buyer all the way. Those are things that need to be done and need to be done right, or else you could have a mess on your hands. So keep that in mind, educate your buyers, and make sure they understand that they have to trace it. So if you're gonna borrow money from your brother, make sure your brother knows we're gonna need to see those bank statements. And if your brother has $7,000 in that bank account and he puts it all in your account, that's fishy. If he has a normal account that is 7, 8, 10 on a monthly basis, and then he gives you the 7, then that looks legit. So keep those things in mind. FHA is an appraisal issue. The appraisal stays with the property, not the buyer. Obviously on the seller side, it's important you know that. If you get a low FHA appraisal, you're stuck with it. If you represent the buyer and they get a low FHA appraisal, they're stuck with it. Number one, the biggest problem is, A, they paid for the appraisal. B, they probably paid for the inspection. C, they've already told their friends, family, and probably already looking at movers, and now they find out halfway through the process that it didn't appraise and it's a nightmare. So you can't control that. I don't expect you to wave a magic wand and make appraisals come in higher, but you need to educate your buyers on that so they're prepared. So when you're prepared, then you have a plan B in place if that happens, okay? Some FHA loans will let you come up with the extra cash, some won't. There's a lot of stipulations depending on the lender, depending on who's doing the loan. Check with your lender on those. Some have to do with reserves, some have to do with income, DTI, so there's a lot of variables. If that would happen, it's not the end of the world, but it's something you could definitely look into. There is a final review prior to funding. Tell your clients, don't pull credit, don't get a credit card, don't buy airline tickets on your Visa, don't spend any money while you're in escrow on anything debt related. If you go out to dinner, that's fine. If you're gonna buy groceries, that's fine. If you're going out to dinner at a very expensive restaurant, don't put it on a credit card. It could throw your DTI off like that. And most FHA buyers are gonna be very tight on that DTI number. One $200 dinner could, believe it or not, throw their DTI out of whack. It could take it up that one point to disqualify them for the loan. Actually had a client put 2 airline tickets to China on a credit card. Luckily, mom and dad came in, paid off the credit card, and the DTI went back down to where they needed to be. So make sure you educate your clients. That's your main job, educating them. Finally, the max loan amount is $289,193. Once you add in the 3.5% down payment, you're looking at roughly a $300,000 sales price. So if you have a guy that says, hey, I have a $325,000 budget, I want to go FHA, he better have a lot of reserves because they're only going to lend them $289,000. So he needs to come up with the rest on his own. So that's basically the quick rules on FHA. Again, you're going to deal with it the most because it's the most amount of buyers, it's the most amount of clients out there doing FHA loans. So if you have any other questions, let me know. But I appreciate you watching and add this to your repertoire of your knowledge so that when you're dealing with buyers and sellers, you can speak intelligently about an FHA loan. Thank you. Have a good day.